Hi guys, welcome to our channel, The Mechanics of Making Money. Today we're diving into the fascinating world of finance, and we're kicking it off with the Federal Reserve, a powerhouse in the US economy. Established in the early 20th century, the Federal Reserve, also known as the Fed, serves as the nation's central bank. It's like the financial heartbeat of the country, influencing money flow, interest rates, and yes, the hot topic of the day, inflation. But before we get ahead of ourselves, let's take a moment to understand what inflation is. Think of it as the general rise in the price of goods and services over time. Picture this. You walk into your favorite coffee shop and suddenly, your daily cup of joe costs a few cents more. That's inflation in action. And while a few cents might not seem like much, multiply that over millions of transactions, and you'll see why it's so vital to keep this under control. Now you might be wondering, how do we measure inflation? The answer lies in the Consumer Price Index, or CPI. It's a tool that tracks the changing prices of a basket of goods and services, giving us a snapshot of inflation at any given time. So what's the Federal Reserve's role in all of this? Well, one of its primary responsibilities is to manage inflation. The Fed uses various tools to keep inflation at a steady, manageable rate, aiming to prevent those extreme spikes or drops that could send the economy into a tailspin. Why is this important? A stable inflation rate fosters economic growth, encourages spending and investment, and ultimately protects your purchasing power. That means your hard-earned dollars retain their value over time. In essence, the Federal Reserve's job is to keep the economy running smoothly, and controlling inflation is a big part of that. We will delve deeper into how the Fed does this and explore whether it could fix inflation if it wanted to. Now you might wonder, how exactly does the Federal Reserve control inflation? Well, the Federal Reserve, often referred to as the Fed, uses three main tools to regulate the amount of money flowing in the economy, and by extension, control inflation. These tools are the interest rates, reserve requirements, and open market operations. Let's start with interest rates. The Federal Reserve can raise or lower the federal funds rate, which is the interest rate that banks charge each other for overnight loans. When the Fed raises this rate, borrowing becomes more expensive. This discourages banks from lending, meaning there's less money circulating in the economy. On the other hand, when the Fed lowers the rate, borrowing becomes cheaper, encouraging more lending and therefore increasing the amount of money in circulation. Next, we have the reserve requirements. This is the minimum amount of funds that banks are required to hold in reserve against deposits made by their customers. By raising the reserve requirements, the Fed can reduce the amount of money that banks have available to lend, thus decreasing the money supply. Conversely, by lowering the reserve requirements, the Fed increases the amount of money available for lending, thereby increasing the money supply. Finally, there's open market operations. This involves the buying and selling of government securities, such as treasury bonds. When the Fed buys these securities, it essentially pumps money into the economy, increasing the money supply. Conversely, when the Fed sells these securities, it pulls money out of the economy, reducing the money supply. So, by adjusting these tools, the Federal Reserve can influence the amount of money in circulation, which then affects inflation. In theory, if the Fed increases the money supply, it can lead to inflation, as more money chasing the same amount of goods and services can push prices up. Conversely, if the Fed decreases the money supply, it can help to reduce inflation, as less money in the economy can lead to lower prices. And that's a simplified look at how the Federal Reserve controls inflation. But remember, in practice, managing inflation is a complex task that involves many moving parts. But here comes the million-dollar question. Could the Federal Reserve fix inflation if it wanted to? In an ideal world, the answer would be a resounding yes. The Federal Reserve, often referred to as the Fed, does have several tools at its disposal to influence inflation. It can adjust interest rates, change reserve requirements, and conduct open market operations. These measures can either stimulate economic growth, which might increase inflation, or slow down the economy, which could reduce inflation. But in reality, the situation is far more complex. The Fed can't directly control inflation, but it can influence it. You see, inflation is a multifaceted beast, affected by numerous factors both domestically and globally. Consider this. If the global economy takes a downturn, the demand for American goods might drop. This could lead to lower prices, thus decreasing inflation, regardless of what the Fed does. Similarly, if the government decides to increase spending significantly, it could stimulate the economy and potentially increase inflation, again, irrespective of the Fed's actions. Furthermore, the tools that the Fed has are not always precise. Adjusting interest rates is a bit like trying to hit a bullseye with a bow and arrow in a gusty wind. Even the most skilled archer will have trouble hitting the mark. The same is true for the Fed. It's challenging to predict exactly how changes in interest rates will affect the economy and thus, inflation. And let's not forget about time lags. The effects of the Fed's actions don't happen overnight. It might take months or even years for the effects to fully materialize. This delay makes it harder for the Fed to respond quickly to changes in inflation. So could the Federal Reserve fix inflation? In theory, yes. In practice, it's a bit more complicated. While the Federal Reserve has tools at its disposal, fixing inflation is not as simple as flipping a switch. It requires a delicate balance of various measures, a deep understanding of the economy, and a bit of patience. While the Federal Reserve has tools at its disposal, fixing inflation is not as simple as flipping a switch. To look at what we mentioned, the Federal Reserve plays a crucial role in maintaining the economic stability of our nation. It uses various tools such as open market operations, the discount rate, and reserve requirements to keep inflation in check. However, it's not a simple process. The Fed must carefully balance inflation control with other economic objectives like full employment and stable growth. Missteps can lead to unintended consequences such as stagflation or recession. Therefore, even though the Federal Reserve has the power to influence inflation, it's not as straightforward as flipping a switch. That being said, understanding these concepts can help us make informed decisions about our finances. So keep learning, keep questioning, and most importantly, keep engaging with the world of finance. Thanks for watching. Please remember to like, subscribe, and share so you see our future videos pop up on your newsfeed. Stay safe out there, guys.